Greetings, my name is Ted Hicks. I am the Chief Investment Officer for Hicks Associates Wealth Management. Today is Friday, November 3rd, 2023, and this is our monthly market monologue where we go into a little bit extra depth and review what we see in the stock market. We will also look at some of the economic data. Now, for those of you who are new to our channel and are not yet clients, let me introduce you to my firm. Hicks Associates Wealth Management serves individuals and families in a proactive capacity. We serve them by being intimately familiar with their finances so that we can guide them with data-backed advice. Now, for most of our clients, we also serve as portfolio manager, managing their portfolios in a truly active, fee-based, and a fiduciary capacity. If you want to learn more, simply visit our website, hicks-associates.com, or simply email me directly. We would be happy to see if we can't be of service to you. That said, let's dive in. On the screen right now, we have some of the major indices through October 31st, and we want to highlight a couple of things. On the right-hand side, top right, we see that this is the NASDAQ. The NASDAQ Composite Index is positive approximately 24% through the end of October. Next up, we have the S&P 500 and the Russell 3000. We spend a fair amount of time talking about those two indices and the data underlying those, but we really want to spend just a minute highlighting what you see in the bottom right. This here is the New York Stock Exchange average, and you can see that that data is negative 1.5 for the year. RSP represents the S&P 500, but the equal weighted version. We'll spend a minute talking about that and highlighting the difference. If you look at the equal weight S&P 500, those stocks are down almost 4% for the year. Then we have small cap stocks, negative 5%. And finally, the value line geometric index, negative almost 6%. The challenge, and when we look at some of this data, is most of you, if you're watching the news media, you're hearing that the S&P and the NASDAQ did whatever. The challenge is those indices, as we will show you again, are cap weighted, and they are very, very deceptive, especially this year. Now, one of the things that you can also see with just the naked eye on this chart is from the end of July, there's been a bit of a downdraft in all of these major indices. Now, whenever the stock market begins to pull in like this, especially over a prolonged period, there is concerns that that is forecasting a recession. That's one of the things we're going to talk about today because, as you know, the economists as a group have been crying for a recession for well more than a year. We have been skeptics from the beginning. But when we see the stock market behaving like this, we begin to take a little bit closer notice. Maybe we will actually see the recession that they have been forecasting for more than a year. We'll look at that in just a minute. On the screen now is a copy or a screenshot, if you will, of the Atlanta Federal Reserve's GDP Now tool. And we showed this in last month's video because we wanted to talk a little bit about what they were forecasting. So we're highlighting the fact that September 29th, 2023, the Atlanta Federal Reserve was forecasting that the third quarter GDP would come in at a positive 4.9%. Well, just this last week, we finally got that data, and lo and behold, it was indeed 4.9%. So that doesn't mean that the Atlanta Federal Reserve is always accurate, but last month in particular, they were spot on. Well, what are they saying for the fourth quarter of this year? So I grabbed this screenshot earlier, I guess last week, October 27th, the Atlanta Federal Reserve is forecasting that the fourth quarter GDP will come in at a positive 2.3%. However, we also want to highlight, take a look at what the blue chip consensus estimate is. You can see that this is a range of the top 10 and bottom 10, the average forecast from the blue chip consensus forecasters. And you can see that their average is actually less than 1%. There's a little bit of a difference. So the GDP from forecast from the Atlanta Federal Reserve 2.3, but the blue chip consensus is coming in or forecasting at less than 1%. Well, let's take a look. What did the blue chip consensus estimate look like for last quarter? So now we revert back to the data that we showed you. This is again from last quarter. You can see September 29th, but in particular, you can see the blue chip consensus and how that forecast changed as they got more and more data. At the beginning of the quarter, they were actually forecasting a flat, even some negative forecast. But as the quarter drew on, they got closer and closer to 3%. but they were still off, and the Atlanta Federal Reserve was spot on accurate. Again, that's not a promise to say that the Atlanta Federal Reserve is always accurate, but it's just recent history. So that's not recessionary. You can see on the GDP histogram chart that the GDP was coming in, and then we had this very robust third quarter. And if the Atlanta Federal Reserve is accurate and this number comes back down, that's still an expanding economy. Yes, it's slowing down a little bit, but that's still not recessionary. So here we have the federal funds rate, and as you likely know, Chairman Powell in the Federal Reserve concluded a two-day meeting this Wednesday and announced that they are leaving interest rates unchanged. In the press conference afterwards, Chairman Powell discussed the fact that they believe that they have been aggressive enough and they now need to wait and see. And that wait and see approach is due to some studies that suggest that when the Federal Reserve raises or lowers interest rates, on average, it takes about 9 months for that change to really take effect in the economy. So Chairman Powell and the Federal Reserve have been very aggressive in raising interest rates, but what they're effectively saying is now let's take a wait and see approach. Let's see if these changes have a broader impact. They know inflation is still a problem, but they don't want to be too aggressive. They're hoping to achieve that quote unquote soft landing where they can bring inflation down and get inflation under control, but not actually cause a recession. So now that's where they're at. Let's wait and see. I believe last month we talked about Dr. Copper. Copper is a leading economic indicator, and one of the things that I had highlighted was the fact that the price had come down and actually was breaking through this short-term support level. It certainly didn't look good. In the last several days, copper prices have climbed back up, so that is inconclusive. However, let's look at what we call the credit index. This is the Chicago Federal National Financial Conditions Credit Sub-Index. And you can see that we're at a kind of hovering back towards this zero line. And if you look at the gray bars, what you can see is this credit index rises as we're going into a recession. Now, from the Chicago Federal Reserve, they are saying index points to steady financial conditions in the week ending October 20th. This is a little bit delayed. So again, if we just look at the data, we would certainly say that this so far is not pointing to a tightening financial condition which suggests a recession. So this is good news. Now we have industrial production, and quite frankly, if this was a stock, this would be something I'm interested in because you can see that the industrial production is at kind of all-time highs, and it certainly looks like it's about to move higher. So again, this is not recessionary. Next up is job openings, and in the most recent update, we saw a surprise. The economists were expecting job openings to continue to decline. Well, they moved higher. Quite frankly, the job market has been incredibly resilient, and that is, again, not suggesting a recession. We're now going to transition and talk in more detail about what we see in the stock market. And if you have been watching our channel, you know that we have been saying that 2023 is not really a bull nor a bear market. And we're going to talk a little bit more about why we say that. So on the screen right now, we have a monthly candle chart, and we're simply trying to highlight quickly that the last 3 months in the S&P 500 have been pretty negative. But if we switch to a daily candle chart, this is what we really want to zero in on, because we've been talking about this black line here is the 200-day moving average. And generally speaking, when a stock or an index falls below a 200-day moving average, that is not a good sign. And we were in this battle zone between these two levels, 4,200 and approximately 4,300, and at least temporarily, the bears won, pushing us into a lower battle zone between 4,000 or 4,550 and 4,200. Now, this chart is updated through October 31st. In the last couple of sessions, the stock market has rallied relatively strongly, pushing us back above the 200-day moving average, and the futures market is forecasting that the market is going to open a little higher again today. So perhaps this dip below the 200-day moving average was only temporary. However, one of the things that we have been concerned about is we've already, up until from the peak down to this drawdown was approximately an 11% pullback. And when we fall through this 200-day moving average, there becomes an increased chance that we're going to retest some of these other lows. And if that happens, that's another 15% down, which would be a full 24% drawdown if that were to happen. Now, again, we're not making any predictions. We're not prognosticating. We're simply reacting to what we see. And so the good news is, again, for now, we have climbed it back above the 200-day moving average. And so perhaps this temporary pullback is now over. So now we'll flip and we'll look at the NASDAQ monthly candle chart, again, showing the same thing. The last 3 months have been pretty negative. This is the S&P 600 monthly candle chart. You can see this is not a strong trend at all. Again, the last 3 months pretty negative, but overall, the small cap space has really struggled. And generally speaking, in a healthy bull market, small caps are going to participate. Now, again, small caps are the smaller companies. So in a general bull market, you're going to see, or you historically see, small caps are going to participate. That has not really been happening this year, which has been one of the reasons we have been concerned. Now we look at some of the participation levels, again, to show you where we were at the end of October. Again, the top pane is the S&P 500, and here we're simply looking at the percentage of the S&P 500 that is above the 20-day, the 50-day, and the 200-day moving average. And you can just see that there was this trend of more and more stocks that are failing and falling below that long-term trend indicator. That's not a healthy sign. If we then look at the same data, but now on the Russell 3000, we see a similar trend, just a deterioration in the number of stocks that are in a positive trend. So now we're going to switch gears and talk about cap weighted versus equal weighted. I'm going to again attempt to explain this because I keep referencing it. And also we know that not all of our clients watch every single one of our videos. So what do I mean when I say cap weighted versus equal weighted? Well, on the screen right now is the Magnificent Seven. This is an equal weighted version of it. I just took the 7 top stocks, as I'll show you in a second, and created a custom index or a custom code in my software. And that's what you see. And you can see that this Magnificent Seven, these 7 stocks have really been moving sideways since June or July. Now, this chart again updated through the end of October, and you can see that at the end of October, this Magnificent Seven group had fallen below that support zone, which again, what we were arguing is a very dangerous sign, because it's these 7 stocks that have really been propping up the stock market as measured by the S&P and the NASDAQ. Lately, the last 2 days, these 7 stocks as a group has reclaimed this support zone, so that's good news. But let's get into the details. What do I mean when we talk about cap weighted? On the screen right now is the top 25 stocks in the S&P 500, but you can see the red box. That's where I'm highlighting the weighting that these stocks have in the S&P 500's calculation. So you can see Apple represents about 7% of the S&P 500's index return. Microsoft is approximately 6.7% of the index's return. So if you take those 7 stocks, and it's the same list right here, if you take those 7 stocks, the top stocks are the Magnificent Seven. Now, if you do the math from the prior page, these 7 stocks represent about 26.2% of the S&P 500's weight. What does that mean? Well, if you take those 7 stocks, again, 26.2% of the cap-weighted S&P 500 index, but if instead you assigned those 7 stocks the same weight that all of the other stocks in the index are given, those 7 stocks would represent only 1.4% of the index's return. So what does that mean? Well, let's do some math. Here we have on the screen those 7 stocks, and again, these returns are through the end of October 24th. And if you do the math, if you do that math again through October 24th, these 7 stocks have given the S&P 500 a positive return of 19.12. However, through this date, the S&P 500 is only positive 11%. What does that mean? It simply means that all of the other stocks as a group are negative. That's what we've been talking about, is that these 7 stocks in particular, you can see Nvidia's massive return this year, and Facebook and Tesla, these massive returns of these overweighted stocks have had an over influence on the S&P 500 return, where it's giving the impression that the quote-unquote stock market is moving higher, but the reality is not true. The average stocks are down. And I showed this to a group that we presented to here recently. Whoever came up with the name for the Magnificent Seven for these 7 stocks has obviously not watched the movie, because if you've watched the movie, you know it's a great movie, but it doesn't end well. So we will wrap up this month's video by looking at the seasonality chart, and I'm showing on this screen the average performance of the S&P 500 since 1950. And in particular, this slide, I'm trying to highlight how September 2023 was far worse than the typical September. Again, historically, September is a pretty tough month, but September of 2023 was far worse than normal. If we now include October 2023, again, same data, I'm just including October, we see that October is negative, far worse than the historically seasonally positive month of October. Again, what we've been talking about is that towards the end of the year, October, November, December, and January, those are the 4 seasonally strongest months of the year. That doesn't guarantee anything, and that is why we tend to react to what's happening, not to what has happened in the past. So while October is historically strong, this October was not strong. While this data suggests that November is the best month in the stock market year on average, that doesn't mean anything. That doesn't mean that we will see a strong month. Again, so far futures are positive. It's entirely possible that this pullback that we've been experiencing arguably since the end of August, perhaps that is over. The data is unconclusive. We will see what happens and what transpires. Obviously, if you're a client of ours, there's nothing you need to do. We are actively managing the portfolio for you. If you have any questions or would like to learn more about how we serve our clients, in particular our portfolio management, by all means, feel free to reach out. You'll find our information at hicks-associates.com. Again, until next time, we thank you for watching. We hope you find these videos helpful. If you haven't already, we hope you'll hit that subscribe button. Talk to you soon.